If you want to invest, but the different options of stocks, ETFs, and index funds have you feeling overwhelmed and confused about how to get started, this video is for you. Hey everyone, welcome to my channel. My name is Reni. If you're new here, welcome. And if you're a returning subscriber, welcome back. Today, we're going to tackle a question that I get asked pretty often by new investors. And the question is, what is the difference between an ETF, an index fund, and a stock? When we get started with investing, we see all these options to choose from, and sometimes it feels so overwhelming that we don't even start because we don't know what to choose. In this video, I am going to break them down so you can feel more confident when you start investing. I've teamed up with TD Direct Investing to bring you this video. I've been using their platform for the past almost 10 years, and everything that you need to get started on your investment journey can be found within the platform. It's like a financial toolkit. All your data, insights, and resources can be found in one place. So whether you're a seasoned investor or you're just starting, TD Direct Investing can help simplify the complexities. They were also named the best online broker for investor resources in 2023 by MoneySense, and for good reason. Throughout the video, I will show you how TD Direct Investing can help you on your investment journey, whether you're buying a stock, an ETF, or an index fund. Just so you know, you could get $300 or more with TD Direct Investing. Start by opening an account today. Conditions do apply, and offer ends March 31st, 2024. Now, let's get into the video. The first thing that you need to know when you are buying stocks, ETFs, or index funds is that you are doing what is called self-directed investing. Self-directed investing is like taking the wheel of your own financial journey. Instead of relying on someone else to do the investing for you and to make all the decisions for you, you get to choose exactly where you want to put your money, whether it's in stocks, ETFs, index funds, or another investment. You choose your own risk tolerance and place your own trades, and you can do this all via TD Direct Investing. Okay, so we have ETFs, stocks, index funds. What sets them all apart? Let's get into it. First, individual stocks. This is likely the investment option you have heard of most frequently. There is this place called the stock market. I like to think of it like a mall or a flea market. There are a bunch of different businesses or stalls, and you can purchase from any of these stalls. If I go over to company ABC and I purchase it, I am now a shareholder and I own part of that company. Now, you can go and do this for any company that is listed publicly on the stock exchange. When the company experiences growth, you also experience that growth because your share will increase in value. On the other hand, if the company experiences a downturn and they lose value, your share will also lose value. When it comes to individual stocks, here are some of the pros and the cons. The first pro is that you get ownership. When you buy that share, you get ownership in a company, and with this, you get voting rights, which means you can vote on decisions that impact the company. The second pro is that with individual stocks, you may potentially see higher return. Let's say you purchase a stock for $100 and over time it grew to $120. You just got $20 of profit just from owning that stock. Of course, you have to sell it to actually realize those gains. The growth that you experience from this individual stock can be much higher than an investment that would be more diversified, like a fund. One last pro is that individual stocks are usually a very flexible investment to hold. This is because you can buy and sell them at any time, meaning that you can take your money out pretty quickly, typically, and because of that, it is a very liquid investment. On the other hand, there are a few cons that are associated with owning individual stocks, including a lack of diversification. What this means is that if you own a share of company ABC and that company is in a sector that is experiencing economic downturn right now, so the economy is going down, this could significantly impact your investment if all you hold is that one share. Since you're holding just that one individual company rather than a bunch of different companies which can balance it out, you have higher risk because there's a lack of diversification there. If I use the same example as before, that company that you bought for $100, let's say the economic downturn happens and it is now worth $80. If you decide to sell your stock at that time, you have lost $20 and it's not balanced out because you only have your money in this one individual stock. The last con that I'll mention is that owning individual stocks is a bit more research intensive than owning other investments. And of course, whichever investment you are going to purchase, you need to do research, but some require more research than others. When you're investing in an individual company, it can often be more research intensive because you want to look at the financial statements, you want to look at how the leaders of each company are, and that can become a bit more time consuming than if you were investing in a different investment. Thankfully, TD Direct Investing has online learning resources built into its platform. This includes curated learning paths to help you become more knowledgeable about investing, which is really helpful. Next, we have ETFs or exchange traded funds. I like to think of this as a basket of goods inside of it. They can hold stocks, bonds, and other investments all within this fund. So instead of you picking individual stocks, you have all of them within this fund and is created by a professional fund manager. Here are the pros. Number one, it is typically more diversified. Remember when I said that investing in individual stocks can lead to a non-diversified portfolio? It is not really the case when it comes to ETF. Because an ETF can hold a mixture of different assets, it provides diversification in one single investment. This is not to say that all ETFs are fully diversified, because you can have an ETF that just holds tech stocks or just holds a certain sector, but it provides more diversification than just investing in one individual company within that sector. The second pro of an ETF is that they are typically low cost. So a fund manager will create the fund, which means that you have a professionally created fund. However, you're not paying the fees that are associated with typical funds that are actively managed. An ETF is passively managed, meaning that the creator of the fund is not going into the fund and trying to add more stocks or take away stocks. They have created it and they leave it and they let it grow. So when it comes to that, they are typically lower cost than another type of fund, like a mutual fund, for example. Don't get me wrong, there is a fee that is associated with having an ETF, but this fee is typically much lower cost than the other actively managed funds that are available. Lastly, just like stocks are traded on the stock exchange, ETFs are also traded on the stock exchange. This offers a level of flexibility because you can buy and sell your ETFs throughout the day, and you can access your money pretty quickly in normal circumstances. Now let's go on to some of the cons of ETFs. The first one will be limited upside. Since there are a lot of holdings within an exchange traded fund, this means that you may not experience the same growth that you would get from an individual stock that is doing well. For example, some ETFs have up to 3,000 companies in them. Of course, some companies will be doing well and getting high returns. Some companies won't be doing so well. So you have a balanced portfolio, and because of that, it will balance itself out and your returns may not be as high as if you were just investing in that one company that was doing well. This is a con, but it was also a pro because some of the companies are doing poorly, and if you choose that poor company and you're investing in it individually, if it's in this fund, you'll actually have a balanced portfolio because you'll have the other ones that are doing well balancing it out for you. The last con is that when it comes to investing in ETFs, there are fees associated with it. ETFs typically have what we call a management expense ratio, and this is a fee that is embedded within the product. Before you purchase any ETF, just make sure that you check what the MER is on it. Now, let's talk about index funds. Index funds are a fund that aim to mimic an index, and there are lots of different indexes around the world. An example of an index would be the S&P 500 or Standard & Poor 500. This is 503 of the largest companies in the United States by market capitalization, and an index fund would try to match the performance of all 500 plus companies. These funds are passively managed and they offer a pretty broad market exposure. It's like investing in the overall performance of a group of stocks. Index funds can also provide diversification. They provide diversification by tracking a market index, thereby reducing your individual stock risk. One of the pros: index funds are passively managed, as I mentioned earlier, and because it is passively managed, this means you are going to pay lower fees than a fund that is actively managed. On the other hand, with the cons, there is limited upside with index funds. Index funds aim to match the performance of an index, meaning that you may not outperform the market. The last con would be a lack of flexibility. When it comes to index funds, unlike ETFs or stocks, which are traded throughout the day and you can take your money out at any time throughout the day, index funds only can be traded at the close of the day. So what this means is that you will have to wait till the stock market closes at the end of the day, and then you will be able to trade your index fund. So if you need money throughout the day for some reason, then this makes it a little bit more difficult if you do own an index fund. Okay, so now you know the difference between an ETF, a stock, and an index fund. Which one do you think that you would pick if you were going to start investing now? Let me know. Considering all the options that you have at your disposal, you want an investing platform that not only supports your choices, but also guides you through them. That's where TD Direct Investing really shines. They have a range of investment products available for both Canadian and US markets. Plus, the market research center that they have is a gold mine. And remember, knowledge is power, so definitely check that out. You could get $300 or more with TD Direct Investing. Start by opening a new account today. Conditions apply, so make sure you use the link in my description box to learn more details. So there you have it, an overview of ETFs, index funds, and individual stocks. I hope that you found this video helpful, and if you did, make sure to leave a comment down below. And if you have any questions, please also leave them down below. Thank you so much for watching. I really appreciate you for watching this video, and I'll see you in the next one. Bye.